Brent crude had $114 a barrel on Wednesday morning, and the Bank of Canada did nothing. That is the paradox sitting at the center of Canadian markets right now. Oil prices have surged more than 90% above where the bank forecasted them just 4 months ago, and yet Tiff Macklem held the overnight rate at 2.25% for the fourth consecutive meeting. The reason is not complacency. It is a trap. The Strait of Hormuz has been effectively closed since the U.S. naval blockade began in February. Roughly 20% of the world's seaborne oil passes through that strait. With the blockade showing no sign of lifting, Treasury Secretary Scott Bessent declared this week that Iran's pumping will soon collapse. The energy price shock is no longer a short-term spike. It is becoming structural. Brent touched $119 earlier this month. WTI cracked 107. Canadian gasoline prices followed, pushing headline inflation from 1.8% in February to 2.4% in March. The bank expects it to hit 3% in April. And here is where the trap closes. Raising rates to fight that inflation would crush an economy already running at 1.2% GDP growth, a figure dragged down by U.S. tariff pressure and a soft labor market, with unemployment stuck between 6.5% and 7%. Cutting rates to protect growth would pour fuel on an energy-driven inflation fire. Macklem used the word stagflation explicitly in March. He repeated the dilemma on Wednesday. Economic weakness combined with rising inflation is a dilemma for central banks, he said. The rate for now stays. What Macklem did signal, carefully, in unusually candid terms, is the direction of the next move. If oil prices stay elevated and start bleeding into non-energy prices, there may be a need for consecutive increases in the policy rate, he warned. Scotiabank already projects 3 hikes in the second half of 2026, pushing the rate to 3%. Most other major banks, TD, CIBC, BMO, National Bank, expect the rate to stay flat all year. The gap between those two camps is the Hormuz blockade. If U.S.-Iran talks break down entirely, Scotiabank's scenario becomes the base case. The CUSMA trade review due July 1st adds a second variable. A collapse in those talks could force cuts, not hikes, to support growth. The bank is navigating between two fires. The energy shock running through oil and gas prices is visible and well-priced. What the market has not fully absorbed is the second-order consequence moving through the global food system. Fertilizer prices have doubled since the Strait of Hormuz closed. That is not a coincidence. It is a direct causal link. Crude oil is not just an energy input. It is the primary feedstock for nitrogen fertilizer, the chemical backbone of modern agriculture. Roughly half of all fertilizer feedstock exports in the world pass through or near the Persian Gulf. With the strait blocked and disruptions cascading through regional logistics networks, the feedstock supply chain has fractured. Fertilizer producers from the Gulf, which supply a significant share of the global market, are operating at reduced capacity or rerouting at enormous cost. The price signal has already moved. Fertilizer costs doubled in 2 months. For Canadian farmers, the timing is particularly sharp. Spring planting season is underway, and input costs are biting at the exact moment crop margins were already under pressure from tariff-related export uncertainty. For the global market, the stakes are higher. As the Anadolu Agency noted in a fact box this week, roughly half the world's caloric intake depends on crops grown with synthetic fertilizer. A prolonged Hormuz disruption is not just a commodity shock, it is a food security event in slow motion. The Canadian connection runs through Nutrien, the world's largest potash producer, whose shares have tracked fertilizer price gains on the TSX. But Nutrien's upside is asymmetric. Rising fertilizer prices boost its revenue, but the same supply disruption constraining competitors also tightens its own logistics. The net effect is more complex than a simple commodity windfall. The deeper implication is for inflation. If fertilizer costs stay elevated through the planting cycle, food price pressure will build into the summer, giving the Bank of Canada's stagflation dilemma a third dimension it did not have in January. While the Bank of Canada navigated between stagflation and recession risk, the Carney government made 2 bets this week that signal a longer-term repositioning of the Canadian economy. Both carry real market implications. The first is Shell's $16.4 billion acquisition of ARC Resources, announced Monday. The deal, Shell's largest in more than a decade, establishes Canada as a heartland in Shell's global portfolio, combining ARC's 1.5 million net acres of Montney gas fields with Shell's existing 440,000 acres in the same region. Shell CEO said the deal will strengthen our resource base for decades. The strategic logic is visible in the timing. With Hormuz closed, global buyers are aggressively repricing the value of non-Gulf energy supply. Canadian gas, piped to LNG terminals and shipped to Asia, is now an explicit hedge against Middle East disruption. Oil majors are repricing Canadian energy assets accordingly. SHEL's share price has gained 16% since February. The second bet is geopolitical. Canada was selected this week as the host nation for the new multinational Defense, Security, and Resilience Bank, a 19-country institution that will provide long-term, low-cost financing for NATO defense projects. Montreal will host the bank. Mark Carney also announced Canada's first sovereign wealth fund, seeded with $18.3 billion. Taken together, these moves, the Defense Bank, the Sovereign Fund, the pivot to Asian auto partners, and the SHEL energy deal, form a coherent response to U.S. trade pressure, diversify capital flows, anchor multilateral institutions on Canadian soil, and position Canadian resources as a geopolitical asset rather than a U.S.-adjacent commodity. Gold is the instrument tracking this broader repricing of geopolitical trust. Deutsche Bank published a note this week projecting gold could reach $8,000 an ounce within 5 years. The mechanism is de-dollarization. Central banks globally have cut their U.S. dollar reserve share from over 60% in the early 2000s to roughly 40% today, while adding more than 225 million ounces of gold since 2008. Deutsche Bank models that if gold's share of central bank reserves rises from 30% to 40%, the price implication runs to $8,000. Canadian gold producers, Kinross, Alamos, Centerra, all reported first-quarter results this week showing strong free cash flow at current prices. The weight of evidence points toward continued gold strength, but only if de-dollarization accelerates rather than stalls. The verification benchmark is straightforward. Watch whether the U.S.-Iran peace talks produce a ceasefire before June. A ceasefire would release oil supply, ease stagflation pressure, reduce safe haven gold demand, and restore some confidence in dollar-denominated assets. If the blockade holds through the summer, the Scotiabank rate hike scenario, the food inflation story, and the gold repricing thesis all converge. And the next question is not whether Canada's economy faces stagflation, but how deep it runs.